At Silicon Valley Bank, we deal in innovation. We work with the entrepreneurs, companies, and investors that are defining what comes next.
The events that have happened over the last 24 hours has led to the failure of Silicon Valley Bank, the backbone of the tech industry.
For more than 40 years, Silicon Valley Bank was the go-to financial institution for tech startups and VCs looking to disrupt industries far and wide. Since its founding in 1983, SVB provided critical financial support to firms such as Shopify, A16Z, ZipRecruiter, and Roku. According to SVB itself, 44% of all US venture-backed tech and healthcare IPOs were part of its client roster. And now, this once mighty institution has fallen from grace in what is the largest bank failure since the 2008 global financial crisis. SVB certainly collapsed as a result of poor risk management, but it wasn't entirely the bank's own fault. The Fed and a handful of VCs played a key role in bringing Silicon Valley Bank to its knees, destroying their own industry in the process. Leading up to the collapse, the CEO of SVB, Becker, begged its VC clients to stay calm, saying, "If everybody's telling each other that SVB is in trouble, that will be a challenge. Stay calm, that's my ask. We've been there for 40 years, supporting you, supporting the portfolio companies, supporting venture capitalists." But the VCs showed no mercy. In today's video, I explore what the hell happened and what this could mean for the future of the tech industry. Silicon Valley Bank's origin story dates back to 1983 when Bill Biggerstaff and Robert Mediaris, along with 5 other high-profile investors, were gathered for a late-night poker game. Playing poker while talking shop had become a tradition for these entrepreneurial gentlemen. The tech industry was just taking off, and hordes of young entrepreneurs were moving to Silicon Valley to pursue their startup dreams. Robert Mediaris, who was teaching at Stanford at the time, noticed a common concern among his students. They couldn't quite figure out how to finance their new ventures. Traditional Wall Street banks refused to finance early-stage startups for obvious reasons. It was too risky to issue loans to these unprofitable companies with unproven business models. And so Robert and Bill saw an opportunity to build a new kind of bank to help finance the underbanked.
When you've gone through from the real estate side and been rejected by some of these big banks, you can sit there and all of a sudden come into the fact, well, maybe there is an opportunity for a bank to be in the high technology sector.
Well, let's have one where we really specialize in startups, get to know them, the product and the people. We're really lending to people.
The poker group banded together to launch Silicon Valley Bank, which officially opened its doors on October 17, 1983 in San Jose, California. Roger Smith took on the role as founding CEO, and the SVB team hit the ground running. They grew the bank's assets from $18 million in 1983 to $23 billion by 2013. SVB quickly became the tech world's darling. What was the key to their initial success? Other than SVB's unique approach to provide banking services to the most innovative companies on the planet, the SVB team was ready to hustle from day one.
We were aggressive in the marketplace. We were calling in the marketplace. Our people were out, including myself, every day, every night, calling on the companies that were starting up and some of the more substantial companies.
As with any company's evolution, SVB's original core founding team eventually retired or moved on to other endeavors, paving the way for a new generation of bankers to take the reins. By 2011, SVB had successfully financed over 30,000 startups. It was also in 2011 when Becker assumed the role of CEO, and his tenure marked a turning point for the company. During this time, the federal funds rate was hovering around zero, as central bankers employed a dovish monetary policy to revitalize the global economy after the 2008 financial crisis. This low interest rate environment set the stage for a significant shift in SVB's trajectory, which would become even more pronounced with the eventual increase in interest rates in 2022. So what exactly happened? You and I love studying the fundamentals on this channel, so let's go back to the basics for a second. You see, any bank, whether it's JP Morgan Chase, Wells Fargo, or Silicon Valley Bank, operates by holding customer deposits and utilizing these deposits to lend to borrowers. This is the traditional banking business model. Banks make money by lending money to borrowers in exchange for interest payments. Now, banks can also take these deposits and invest them in riskier assets like mortgage-backed securities in order to generate a juicier return. This practice was of course a major contributing factor to the financial crisis in 2008, and it would unfortunately play a key role in SVB's death warrant as well. As Jamie Quinn pointed out on Twitter, in 2021, SVB purchased more than $80 billion worth of mortgage-backed securities with a goal to hold them for 10 years at an average yield of 1.56%. 1%. Why did SVB buy mortgage-backed securities with customer deposits? Well, here's the thing. Because of SVB's tremendous success, they had grown their customer deposits from approximately $62 billion by the end of 2019 to $190 billion by the end of 2021. Now, what are they going to do with that $190 billion? It's unlikely that they will be able to lend that much money to startups, so why not just take some of it and invest it? This didn't go quite as planned and quickly backfired when the Fed began hiking interest rates at the beginning of 2022. Because of this changing economic climate, VCs weren't raising as much capital from LPs, which means that SVB suddenly saw fewer deposits coming in from its VC clients. However, startups were still burning a lot of cash, and SVB still had to issue withdrawals to their startup clients. This led to a duration mismatch. SVB had locked up its customer deposits in long-duration mortgage-backed securities, but the bank still needed to meet its customers' withdrawal requests in the near term. Therefore, SVB was forced to sell some of its bonds at a loss to cover these withdrawals. But why did SVB's bond portfolio lose value in the first place? The most important thing to remember with bond prices is that they have an inverse relationship with interest rates. When interest rates go up, bond prices go down. This took me a while to understand when I was in college, but there's an easy way to think about it. So SVB's bond portfolio that they bought in 2021 allows them to earn 1.56% every year for 10 years, right? Now, when the Federal Reserve hiked interest rates to 4.57%, SVB's bonds became less attractive on a relative basis. Why? Because if SVB tries to sell its bond portfolio, no one's going to buy it at the original price anymore. Why would I buy bonds from SVB that pay me 1.56% per year when I can buy risk-free bonds from the US government and get paid 4.57% instead? No rational person would do that, and because of this, SVB's existing bonds decreased in value on paper. Losing money on paper because of higher interest rates is obviously not ideal for SVB, but it's not something that would kill the bank. And it's not unique to SVB either. Pretty much every bank has to deal with this. They've all been victim to unrealized paper losses as a result of higher interest rates. But here's where things get really ugly. SVB was a healthy bank and would have survived this unless someone, somewhere, starts spreading a rumor that SVB was at risk of going under. And this is exactly what some VCs started doing. When Silvergate, a crypto bank, went bust earlier in the week, some VCs began to question whether SVB was next. But there was no real reason for SVB to be next. The bank was healthy. However, a handful of VCs urged their portfolio companies and its founders to withdraw funds from SVB as a safety measure in case SVB collapses. Well, by warning their startups, they essentially manifested it into action. And once a rumor like that is on the loose, herd mentality kicks in. Hey, did you hear that everyone is taking money out of SVB? You might want to do it too. Startups panicked and withdrew money from SVB at the same time, which led to a bank run. The VCs caused this run on the bank. This is a classic case of game theory. Bank runs can be avoided, but they rarely are because of human psychology. And the VCs who decided to be extra vocal here didn't help the cause. In game theory, a bank run can be viewed as a collective action problem, where individual customers must decide whether to withdraw their funds based on what they think others will do. If everyone expects a bank run, then it becomes a self-fulfilling prophecy. However, if customers coordinate their actions and decide not to withdraw their funds, then the bank can survive the crisis. This is of course easier said than done, especially in today's increasingly connected world. Twitter can sometimes feel like a giant circle jerk of tech bros who all think the same way, making it incredibly easy to fall victim to herd mentality. This, in combination with the speed at which we can move money around online, makes us particularly vulnerable to bank runs. So what does all of this mean for the tech and finance industry? It's still too early to say as things are still evolving. SVB's collapse could cascade into the broader economy unless someone steps in to buy SVB this weekend. Rumors are JP Morgan could be a potential acquirer. It makes me really uncomfortable to think about the potential consequences if the Fed is unable to facilitate an acquisition. Thousands of startups will be unable to meet payroll and even more employees will be out of jobs. These startups are the future of the tech industry. They're building the world's most innovative products. It sickens me that they are the ones to bear the brunt of this. And I find it troubling that the VC and startup community failed to coordinate their actions and prevent this from happening in the first place. By spreading panic, they were complicit in destroying their own industry and decades of hard work. Their actions feel so short-sighted to me. But maybe it's too much to ask. We're all human at the end of the day, and no one wants to be the last one out of a burning building. I feel for all the startup founders and their teams. Building a business is hard fucking work. You're taking on a ton of risk in order to have a meaningful impact on the world. You're trying your best to allocate capital efficiently, build a world-class team, manage liquidity, and create products that the market will love. The last thing you would expect is that your own fucking bank disappears overnight. I know crypto has been getting a lot of heat over the last couple of years, and rightfully so, but this makes me even more bullish on the notion of self-custody. Trusting bankers and middlemen clearly comes with risks. I think some fintech firms such as Brex will come out of this as winners. They're already seeing an increase in deposits, but more than anything, companies will likely start diversifying their deposits across numerous institutions. This topic is constantly evolving, so things might look totally different by the time you get around to watching this video, but I'd love to hear your thoughts on it anyway. Unfortunately, bank runs happen more often than we'd like. Just last year in 2022, Terra Luna experienced one, and some people think hedge funds were behind it. If you want to learn more about the Terra Luna collapse, be sure to check out this next video. Thanks for watching and see you next time.